And that person is David Rubenstein, Deirdre, the CEO of the Carlyle Group. David, it is a pleasure to have you here again in Davos. I remember our conversation last year well, and we really need to actually pick up on a new theme this year, which is this. Is the developed world driving capital away?
Well, it's a very good question. Clearly, the emerging markets are more attractive to invest in right now than they have ever been. In fact, the emerging markets by the year 2014 will have a GDP greater than the developed markets. That's the first time that's ever happened. The developed markets are more sophisticated in certain areas, and they have more regulatory constraints, and therefore they do make it more difficult to invest in some areas. But I wouldn't say they're driving away capital, but they do make it more difficult at some times to invest.
Is a risk, though, right now, given what we've seen from the President, Paul Volcker, what's going on in England, that will actually become the case, that developed markets will drive capital away, whether they acknowledge that they're doing it or not?
I don't think that they are intending to do that for sure, and I think they are trying to protect citizens and protect the investors. But clearly there are some investors who will say, I think the emerging markets have greater opportunities because the growth rates are so much greater there, not just because of the regulatory constraints in the developed markets, but if China is growing at 10% a year and Europe is growing at 2% a year, China may be a better place to invest.
Let us speak briefly about President Obama's plans for the financial services industry. Earlier on a panel discussion today, you said that the private equity industry isn't certain what position to take. Why not?
Well, we're not directly involved, so there's no need to take a position, really. The President has said that this is affecting the banks and the way banks and other institutions are to be conducted. So we haven't seen the details of the legislation. Right now, we're not in the middle of it. And when you're not in the middle of a fight in Washington, D.C., you shouldn't look for a fight.
That's a fair point. There must be, though, some indirect implications for the private equity industry. Can we really expect Paul Volcker to want the banks to finance private equity deals if he doesn't want them to invest equity in them?
No, I can't speak for Paul Volcker, but I don't think anybody thinks that banks shouldn't finance some private equity deals. I think the issue is just whether banks should do that as a principal investor where the risk is greater than their core business of lending.
But is the risk ultimately that much greater on the financing side than it is on the equity side? Sometimes it seems like the financing side can be more risky than the equity.
Well, traditionally, the equity side is riskier because the equity gets wiped out in bankruptcy, and senior debt, which is what banks usually provide, tends to get rewarded, or at least get its money back. So I would say clearly lending is less risky generally than equity.
How about the implications for individual firms? On the one hand, it seems fairly certain that J.P. Morgan's going to have to get out of that business, given that they're such a big deposit-taking institution. What about Goldman Sachs, though? They're a huge player in private equity. They've partnered with you on many occasions. What do you think will happen there?
You know, I can't speak for Goldman, obviously. Goldman will have many choices. But remember, we haven't seen the details of the legislation. And even Barney Frank, who was a supporter of the legislation, said at the time of the announcement that he thought a 3 to 5 year transition might be appropriate. So there may be even a longer transition. So I don't think the implications, even if the legislation were to pass for private equity, can be predicted right now because it might take a long time for this to go into effect.
Let's talk about what's going on in Britain. Is there any merit in your mind in taxing banker bonuses?
Well, since I'm not paying the bonuses, I'm less involved in it. But I would say
you've been down a similar road before, at least in terms of a conversation.
Right. I understand the sentiment, and clearly I've been in government. I understand the concerns that regulators have. So I don't want to get into whether it's a good or not good thing. But clearly I recognize the sentiment. On the other hand, I think people should recognize that banks and financial service institutions do provide a service to the country, their countries, and they do valuable things. And the focus shouldn't be only on their bonus, but on what they do that's valuable.
Quickly on the global economy, or the U.S. economy, while we have about 35 seconds, you said earlier today it is largely recovered in the view of professional investors. Can we really call it recovered when so much of the recovery has been by the virtue of debt and the deficit?
Well, what I meant to say and what I really believe is that we're out of the recession, and now investors are willing to invest again. They weren't willing to invest so much in 2007 and 2008. That doesn't mean we don't have economic problems. We have enormous debt problems, deficit problems. We have a very high unemployment rate. So we're going to live with the problems of the Great Recession for 2 or 3 more years at least. But I think investors do tend to put money at risk right now.